Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look not only at other indexes inside the stock market, but we also look at other markets to see if they can give us some kind of clues as to what's happening not only in the stock market, but in the S&P 500 itself. This is being prepared for Monday, October 2nd. The first area that we look at is S&P 500 valuation. We look historically to see how is the S&P looking right now compared to historical averages, and then how are we looking right now, and then how are we looking going forward from here. The first chart that we look at looks back, and this is based on the price to earnings ratio, which is set at static numbers of 10, 15, or 20. When we're at 20 or above, we're considered to be expensive, and that's where we're at right now. The black line here is the S&P 500, and then we compare that to the red dashed line. Also on the bottom, we have the difference between the two. So on a historical basis, the market is considered to be expensive. We can also base this around historical events that have happened and what were the valuations like at that time. Well, right now, again, it's just showing that historically we are overpriced. Then we take another look at the Shiller PE ratio. This looks at a more average over a period of time and then compares it with the current price of the S&P. And I have to turn on my laser pointer, where right now we're getting a reading on the Shiller PE ratio of 29.408. To give you some kind of perspective, the median and the mean is between 16 and 17. We can also get some perspective to see, okay, where were we during big events in the stock market looking back? Well, here's the 1929 crash, and we're just about at that same level now. We're dropping just a little bit. And here's the 1987 crash. Again, these aren't things that we necessarily use to make decisions on. We just want to know what is the current state of the market on a valuation basis. Then we also look forward because that's what the stock market does use. And right now, the S&P is coming in with a forward PE of 17.9. The mid caps, just to get more of a perspective, are coming in at 13.2. So they're under that 15 level, but they're above 10. So they're above being inexpensive, but below being fairly priced. Then we look at the small caps, which are inching down even a little bit more. They've been under a lot of pressure lately, and they're coming in at 12.3. Then we look at all of this on one chart just to get some kind of perspective, and we can see that they have a tendency to move in the same general direction when it comes to PE ratios. Then we look at two different small cap indexes, the S&P 500 600 small cap, and that's the blue one. And that's what I use because it lines up with that 10, 15, 20 static range. Well, we also look at the Russell 2000. That's also very popular, and it's coming in at 21.2, and it's on a different scale. So that's why I use both of these. We also look at growth versus value. When the market's really going up, you want to buy low and sell high. That's when you want to buy growth stocks. That's how they get their name. Well, when the market runs into more difficulties, we look at value. These are longer term companies usually that have stood the test of time. Maybe they don't have as much in the way of capital gains, but they might have more in the way of dividends. We look at just a pure growth index where we're showing some weakness right now, but we're still in an uptrend. And then we look at a pure value index where we're continuing to be in a downtrend. Where it becomes interesting is when we compare the two. We take a ratio. Growth to value is on the top, showing how growth is outperforming. And then value to growth is on the bottom, showing how value has been underperforming. Then we look at some ETFs because different indexes, ETFs, and different ways of looking at this will come to slightly different results. So we want to see some conformity across different instruments that we follow. This growth ETF is outperforming the value ETF. Then we look at an inverse of that, showing how value is underperforming growth. Then we look at some indexes showing how growth continues to outperform value, and then value is underperforming growth. And then we look at another index showing how growth is continuing to outperform value. So we're seeing some conformity there. Even though we've been under pressure with the market lately, we're seeing little pockets of positive strength where some of the smart money is coming in to buy growth stocks. Now we need to see that follow through into price action for the S&P 500. We also look at some other measures of growth versus value, how it's turning back up just slightly and in a longer term uptrend. So growth is outperforming. And this is also showing that same thing with an inverse look, showing how value has been underperforming. Then we look at small cap growth versus small cap value, where we're still in a longer term uptrend, but we pretty much have been chopping sideways. We also look at mid cap growth versus mid cap value. This is showing a little bit more strength, but it hasn't broken out of this sideways trend. However, we are in a longer term uptrend. Then this is the one that I focus on the most. This is S&P growth versus value on an end of day basis. In the daily videos that I do, I look at it intraday, where we're coming back down after Friday's session, but we had been showing some strength. We've been chopping more or less sideways, but we're still in a longer term uptrend with the blue line above the red line. We keep an eye on inflation. We look at a monthly chart of the CRB index where it's starting to go back into an uptrend. And then we compare that with the bottom where we take inflationary areas and we do a ratio with deflationary areas. And so far, this is continuing to decline. So even though there are some inflationary pressures in the market right now, it's not really showing up as far as price on a ratio basis. We do look at the CRB index, which is going in an overall uptrend now, and it had crossed over to give us a golden cross. And this is something that we do watch. If it's really going up, there tends to be more inflationary pressures. Then we look at the Baltic Dry Index. How much does it cost to ship products from point A to point B, specifically in the Baltics, where this is showing a bit of a bounce right now, but we're still in a longer term downtrend. But if we continue to go up with this, we'll see a golden cross with this index. Some other markets that we look at, we only look at these maybe once a week or so just to see how things are faring. But aluminum continues to be in a downtrend, where corn is also in a downtrend. Wheat is in a downtrend, and fertilizer, it's chopping down just a little bit and has been bouncing back up, but it still remains in a longer term downtrend. So this focuses more on food and inflationary pressures that we might feel there. Then we look at oil. This is something that does affect us every time we fill our gas tanks, where it's really been going up. Now, the story behind this is that Russia and Saudi Arabia, who had already announced that they were going to cut back on production, a few weeks ago, they came out and said, we're going to continue that until the end of 2023. And that has been pushing oil prices up. And this is also more inflationary because it costs us more and has been putting some pressure on the stock market. Gas, even though it's dropping down right here, it is in an overall uptrend. And we look at diesel. This is another thing that is used to move products and people from point A to point B, where it has been having a tendency to go back up. Heating oil, we're starting to get a little bit colder now, and this is beginning to come back into an uptrend. And then natural gas, which had really dropped, it's coming back up. It's still in a downtrend, but it's starting to bounce up just a little bit. And in copper, we look at this to get a gauge of what is happening economically. When copper's going up, generally looking out into the future, the economy does better. And then when copper's going down, it looks at economic weakness going into the future. And a while back now, we had a death cross where we're in a downtrend with copper. Then we compare copper to gold. When we're having difficult economic times, typically gold will outperform copper. When things are looking better, copper will outperform gold. Well, we're seeing copper really outperforming gold right now. And even though we're seeing what could be economic slowdown, we're starting to see some strength coming back in economically, and a rise in interest rates and a rise in oil and a rise in the dollar, and that's putting pressure on gold. Then we take a longer term look at this same chart. Here's the ratio, which is the black line, and it's been declining. We also plot the 2-year yield, which is in green, and that's been going up, and the 10-year yield, which is in red, that's also been going up. Where what we've seen for a while before this is that these three tend to move in the same overall direction. There's a wide spread between them right now. In fact, we have an inverted yield curve between the 10 and the 2-year, and copper continues to decline on a relative basis compared to gold. And so we're seeing kind of an overall shift in the characteristic of the economy. Then gold is now giving us a death cross. We've crossed below both moving averages and continue to decline. Silver is also giving us a death cross after it has been declining. We look at gold on a closing basis, which has been going down. We look at silver, which is also on a closing basis been going down. And the correlation between the two is quite strong. Whether they're going up or down, they tend to move in the same general direction. Because we have another study here where we take a gold to silver ratio. When this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming, even though they're probably going in the same overall direction. We can compare that to the US dollar index. When this is going up, a general observation that we've made is that gold outperforms silver when the dollar index is going up, where silver outperforms gold when this ratio is going down. And then we look at the correlation between the two, and it has been stronger, but now it's starting to come back to more neutral as the dollar's been showing a lot of strength, whereas gold and silver have been showing some weakness. We keep an eye on the dollar index where it was down in Friday's session, but it's really been climbing. We're back down into the 105s now, where we did get up into the 106 area, and that could put some pressure on stocks too. The stock market tends to like a weaker dollar because for the conversion rates, that tends to make their books look better, and it's also more advantageous from an import-export perspective. Then we keep an eye on the euro, which is coming down compared to the dollar, but it's still in an overall uptrend where the US dollar index has been going up. And then we look at the Japanese yen, which is also in a decline and actually underperforming the US dollar currently. And here's a standalone chart showing how the Japanese yen is in a downtrend. The British pound is still in an uptrend, but has been seeing some weakness now against the dollar. If this continues to fall, we might see a death cross, but we haven't seen that yet. We look at some other indexes. We have the S&P 500, which is a weighted index. So the big mega cap companies, they count for more. Then we look at the red line, which is an equal weight index. Pardon me while I clear my throat. Gotta love these take one videos that I do here. And with the red line, all of the stocks in the S&P are counted the same, and they have been underperforming the S&P. So we're seeing more broad market weakness currently. Then we take a ratio of the S&P 500 to the CRB index, where the S&P has been outperforming even though it's showing some recent weakness. We look at an inverse of that, where the CRB index has been underperforming but seeing some recent strength. Then we look at the NASDAQ 100, which has been doing quite well if you kind of take out September, compared to the S&P, which has also been doing well. But even though we've been seeing some pullbacks, the NASDAQ 100 is still outperforming the S&P. The S&P 100 continues to outperform the rest of the S&P 500. And the NASDAQ, which has been doing well, and the S&P, which has been doing well, the NASDAQ, which has a lot of tech stocks, it's continuing to outperform the S&P. The NASDAQ 100, which are the big mega cap stocks, well, there's a few of them in there, they have been outperforming the rest of the NASDAQ. Then we look at the mega caps, the really, really big companies, and compare it with the equal weight ratio. And this shows that the big stocks have really been outperforming. We look at the small caps and compare them to the S&P. That's the red line, where the small caps have been under a lot of pressure. We want to see this turn and go back up. That often gives support to the S&P, but it just hasn't been happening, at least in 2023. And then we compare that to the blue line, which is the S&P 500. Here's another look at the small cap ratio to S&P 500, where it's ticking back up, but still in a longer term downtrend. The 30 biggest software companies are still in an uptrend, but we're seeing some recent weakness. The mega caps also some weakness, but still in a longer term uptrend. The robotics and AI ETF, which that's all the craze these days, but even the ETF by itself has been really in a downtrend lately, and it's been really underperforming when compared to the tech sector. The Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together, we are seeing some weakness, but it's still in a longer-term uptrend. We look at the S&P and compare it with shorter term bonds based on price, where it has been in a longer term uptrend, but we are seeing some weakness. Then we look at a broad market measure and compare it with further out bonds, kind of the same thing, where stocks have been outperforming, even though they have seen some weakness over the month of September. We look at the low volatility ETF, which is just about ready to go into a downtrend here. These stocks held up much better in 2022. Well, growth has been outperforming value in 2023, and that's why we're seeing this ETF show some weakness. When we compare it to the S&P, we can see how it's really underperforming. Then we look at the tech sector and compare it with 3 to 7 year bonds, where the tech sector had been really outperforming, but lately seeing some weakness. Then we look at the S&P and compare it with other stocks. First, we look at an advanced decline line study. This is the NYSE common stock on the top, where we're below the moving average, and we're also below the moving average with the S&P and the mid caps, and we're continuing to see more weakness with the small caps. We keep an eye on traditional Dow theory. We're on the top, we're breaking below this line here, which was a previous breakout point for the Dow. The transports have been rather weak lately, but they did bounce up and might be showing a little signs of life that I'll show here in a moment. But what has been really weak, and what I include as part of traditional Dow theory, is the utilities, and they're getting pressured by the rise in interest rates and the rise in the dollar. We compare the transports with the S&P 500, where we are starting to go back up. When this line goes up, that means the transports are outperforming, and in a good solid environment, we want to see this line continue to go up. We compare the Dow to the transports. When this is going up, that means the Dow's outperforming. When it's going down, that means the transports are outperforming. Well, we were seeing a climb up here, showing that the Dow was outperforming, but now we're seeing this turn down just slightly. We want to have that continue for things to turn more positive. We take a correlation of the S&P 500 with the transports, and they have a pretty strong tendency to go in the same direction. Then we look at a new take on Dow theory, where instead of using the Dow, we use the S&P. And then on the bottom, instead of taking the transports, we take NASDAQ, which is tech. And these are pretty much going hand in hand with each other. We're not seeing any real convergences or divergences right now. They've both been under pressure. The FANG index, which is Facebook, Amazon, Apple, Netflix, and Google, and some other stocks, where they're still in a longer term uptrend, even though they have dropped below their 50-day moving average. Then we take a longer term look at this, where we set a new all-time high earlier in the summer, and then we've been falling back ever since. One thing that's interesting here is just recently, this past week, we came down and tested this previous low. Is that going to provide some kind of support for the FANG index to go up? That would really help the overall market and the mega caps to perform better, which in turn would have helped the S&P 500 to perform better. ARK, which is in an uptrend and was actually up in Friday's session, but it has also been under some recent pressure. Then we look at a monthly chart of the S&P 500, and where is it compared to this moving average? And even though it's ticking down slightly here, we're still in a longer term uptrend, and we compare it with stocks in Europe, Australia, Asia, and the Far East, and it shows that they're outperforming. We also plot a longer term oscillator on the bottom, the PPO, and that is still above zero and advancing. Then we compare stocks with bonds. The total bond ETF based on price is continuing to decline, and it's in a downtrend. The world bond index has also been under pressure as bond prices have been going down with interest rates going up. But when we look at a monthly chart of the stock to bond ratio, we show that even though both stocks and bonds have been under pressure, stocks are continuing to outperform on a longer term basis. And this just shows where bonds are underperforming stocks. This is the high yield. These are junk bonds, and they've been doing pretty well in 2023. Even though they take on more risk, they do give a greater yield, and folks are willing to take on that risk, even though they've been falling back lately. A lot of times what we see with this index is it tends to mirror the overall stock market in general. Then we look at investment grade bonds. These are more conservative bonds where they're kind of going out of favor now, where we're starting to see a death cross here and a downtrend based on price. So when you compare riskier bonds with more conservative bonds, this ratio is going up, meaning that folks are preferring the riskier bonds. They're willing to take on that risk. We do a correlation between stocks and bonds, and it's very high right now, meaning that stock prices and bond prices are tending to go in the same direction, either up or down. Then we look at the corporate bond index, which we're starting to get a death cross here and more of a downtrend, and they've been going out of favor. And these are typically more conservative than junk bonds, but there can be some risks in here because some of the companies might end up overextending themselves. We look at the 10-year yield, which continues to break out, and that's causing some concern for the stock market. And then we're also seeing what potentially is a longer-term shift, where for 40 years, we were seeing lower highs and lower lows as interest rates were declining. We broke out above that and we continue to rise. And we're wondering if this is going back to the old normal of how things used to be in the 60s and 70s, not so much from the 80s onward. And that's a new paradigm that the market may have to deal with, is higher interest rates. Looking at the 30-year yield, where it's continuing to go up and still not getting back to previous highs, but it has been climbing. And then we look at the performance of the S&P 500 against the rise or fall in interest rates, and we saw a death cross here with this ratio showing that the S&P is now underperforming the rise in interest rates. Junk bonds, in and of themselves, even though they're seeing some recent weakness, are in an overall uptrend. And then we do a ratio between junk bonds and government bonds, and this is just continuing to really go up, showing how junk bonds are outperforming the more conservative government bonds. We look at bond prices based on price, where with the RSI, we're below 50, and that's negative. We did see a recent death cross, and we're in an overall decline, and shorter term, the MACD is also showing some weakness. We look at a daily chart of yields across all the different spectrums, where you can see longer term, we continue to go higher with interest rates, even though we have a number of yield curves that remain inverted. Then we look at an international chart, a weekly chart of how are things looking for the US, UK, Japan, and Germany, where the US rates are now overtaking the rise that we were seeing in UK rates. Germany is also seeing rates going up, and even Japan. These are low compared to the other two, but compared to where Japanese rates have been, they are starting to go back up. We keep an eye on the MOVE index, which measures the volatility of bonds, and that's been going up as bond prices have been going down. And we also keep an eye on the VIX, which measures the volatility of stocks, and that's been going up as well. And then on the bottom, we see that there's a strong correlation between both of these indexes. Then we look at a longer term chart. This is monthly. Here's the price of bonds where they are in a longer term downtrend. But when you compare them with the CRB index, the bond prices are still outperforming the CRB index. But it can take a while for this chart to really shift because we're seeing more recent strength when you look at the CRB index compared to bond prices. We look at the S&P 500 and the different sectors, where we look at the materials sector, which continues to be in a downtrend compared to the S&P. Communication, which has been one of the stronger areas in 2023, it's still in an uptrend. The energy sector could be getting back to giving us a golden cross, but it's not quite there yet. It had really been underperforming, but as oil prices have been going up, we're seeing this ratio show a lot of improvement. We look at the financials. Back in March, that's when we had the banking crisis, and the market's just kind of on edge, wondering if we're going to see any more of that. In the meantime, the financials are really underperforming the S&P. The industrials are also underperforming the S&P. And tech, which has been another stronger area, continues to be in an uptrend compared to the S&P. Staples, which did really well in 2022, they are underperforming in 2023. Real estate also has been under a lot of pressure lately as housing prices are going up, but interest rates are going up, and you're seeing the overall sales going down because people can't afford to get into houses, and that could have a real longer-term negative impact. We look at utilities, which have been under a lot of pressure, as I said, because of the rise in the dollar and the rise of interest rates, and they're in a pretty solid downtrend, which often gives some support to the S&P 500. In fact, that's what we look at here. We look at a ratio. When this is going up, typically the S&P is going up. When this is going down, the inverse of that is true. And we use this because this is not only good at helping us with the overall direction. When this turns and starts to go down, that will often mark a top in the S&P. And the same is true with a bottom. We look at healthcare, which is one of those things you have to have no matter what's happening economically, but it's continuing to underperform the S&P. Here's another look showing how it's underperforming the S&P. Discretionary, which has been a stronger area in 2023 after having a really difficult 2022, it's still in a longer term uptrend. And the staples sector, we're starting to see a death cross here and a real weakness. These are the things that you have to have no matter what's happening economically. Where discretionary, the things that make life more fun, you can choose to have them whether you want them or not. The tech sector still in a longer term uptrend, even though we've been seeing some weakness. The semiconductors also uptrend, but some recent weakness. And when you compare tech to the S&P, tech continues to outperform, even though it's been going flat lately. The energy sector and tech sector taking a ratio where we're seeing a real bounce back in energy as tech has been under pressure, but we're not quite there yet to generate a golden cross. We look at growth stocks and compare them with bond prices, and growth stocks continue to outperform bond prices. We look at the tech sector and then the rise or fall in interest rates, where the tech sector is now starting to underperform the rise in interest rates, and we're getting ready to see a death cross here. Here's an inverse of that same chart where we might be getting ready to see a golden cross as interest rates are going up. That puts a lot of pressure on tech companies because quite often they have to borrow quite a bit. The higher the interest rates, the more that bites into their earnings and ultimately their profits. Then we look at discretionary to staples, showing that discretionary is still holding up rather well, where staples continue to underperform. And gold, we just now saw a death cross with gold, and it's also underperforming the S&P 500. Gold also is continuing to underperform the rise in the dollar. High leverage loans. Again, as I always say, if we were getting ready to fall off a cliff economically, we would not see this ratio, or excuse me, this index in as much of an uptrend as what we're seeing. Then we look at the NYSE composite, which has been chopping sideways. It's still in a longer term uptrend, but we have been seeing some weakness, and we use this for a broader measure of the market. All stocks also seeing some weakness, but still in a longer term uptrend. Emerging markets are starting to roll over and give us a downtrend now as they've been chopping sideways. They were all the rage at the beginning of 2023, and then people just stopped talking about them, and they pretty much stopped moving. They've been chopping sideways. The micro caps, these are real small companies. We're still a little bit above 100 now with this overall index. If we drop below 100, that could be more negative. We want to see micro caps and then small caps doing well, but they've recently been under a lot of pressure. Then we keep an eye on the home builders, where we've been really going down more or less with the S&P. The home builders ETF has also been under pressure. The ratio has also been going down, and we're seeing the correlations start to go in opposite directions now, where they tend to have a high correlation. So we'll be keeping an eye on this. If we get down below this dashed line, that often means that something's out of line, and we're looking for either the home builders to improve or the S&P to pull back. Look at Bitcoin, where it just recently gave us a death cross, and it's been chopping more or less sideways through most of the summer. There is a chart that I show in the other videos that Stock Traders Almanac has come out with a new seasonality chart just for Bitcoin that some of you might find interesting to look at. Then internationally, we're seeing more of a downtrend with China, emerging markets, Europe. Japan's been pretty much flat, and we are still declining in the US. Looking at InterMarket Analysis, going back to the beginning of the year, oil is now in the lead as stocks have been under pressure, followed by the dollar and then gold. And then back as of about the beginning of August, that's when we saw bond prices start to go negative. Some correlations. We look at the S&P 500 with the US dollar index. They're having a strong tendency to go in opposite directions. So if the S&P is up, that will typically mean the dollar index is going down, and vice versa. We look at the S&P to oil, where they were more or less neutral, and now they're having a slight tendency to go in opposite directions, as the rise in oil has been putting pressure on stocks. We look at the S&P 500 to the 10-year yield, where they're going in opposite directions, and the tech sector to the 10-year yield also in opposite directions. Then we look at the S&P to the 2-year yield. We get a shorter term maturity where it's going up here, but it's now in neutral territory. Look at some long-term secular and cyclical trend studies. This is a monthly chart of the NYSE where we're still above the red line, even though we've been showing some weakness. The Kopic curve, which is a momentum oscillator, continues to advance and is crossing back above zero. We look at a daily chart of the NYSE and then look at the NYSE record high percent index, where it had been going up, but we're seeing some weakness as stocks have been under pressure. Then we look at a longer-term chart of the S&P 500, where it also is showing some weakness, but still above the moving average. And the PPO has been going up, but it's starting to roll over. So we want to keep an eye on this. This could be longer-term negative. Then we look at the S&P 500 and compare it to the CRB, where both have been doing fairly well as the CRB has been recovering. So that's why we're seeing more of a trend here. But we're seeing some recent weakness now in the S&P 500, although it's still above the moving average. Then we look at another measure of the S&P 500 on a monthly chart and compare it with a global index, showing how the S&P is still outperforming. But when you look at the KST, it's still suggesting that we're in a downtrend. I don't know if I'd really follow that all that close. So at the very end of this video, I take the whole list of things that are positive. And my definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. We have the growth indexes and ETFs, which are in uptrends. Then the CRB index, the big software companies, the dollar index, the euro and the British pound, when compared to the dollar, even though they've been pulling back, they haven't crossed over negative yet. The mega caps, the Dow Jones Composite Average, the FANG index, as well as ARC. Bonds, when you look at the high yield bonds, which also can mean junk bonds, the riskier bonds, the tech sector, as well as semiconductors, high leverage loans, the Dow, the mid caps, and the small caps, even though all of these have been under recent pressure. The NASDAQ and NASDAQ 100 also longer term uptrend, shorter term pressure. The NYSE composite, all stocks, emerging markets. And then the negative definition that I use is when the 50-day simple moving average goes below the 200-day moving average. The value indexes are still underperforming and in a downtrend. Gold and silver, which is a new addition to this list. Copper, the Japanese yen when compared to the dollar. The low volatility ETF, staples, total bond ETF. This is the more conservative bonds, as well as world bonds. Micro caps, which are right about at that 100 level, investment grade bonds and corporate bonds. Again, more conservative bonds have been under pressure, and now Bitcoin has just given us a recent golden cross. Thank you. I hope you found this helpful. This is not necessarily meant to be used as a standalone video, although some of you might see value in that. It's meant to go in conjunction with the daily and weekly videos that I also post. I hope you have a very good weekend, and I will talk to you in the next video.